Tonight, something unusual is happening in the global markets, and almost nobody on mainstream financial news is explaining it clearly. While headlines focus on missiles, diplomacy, and rising tensions in the Middle East, a quieter story is unfolding behind the scenes. Silver prices are moving in ways that historically signal fear, preparation, and sometimes even insider positioning before major economic shifts. The question isn't just why silver is rising. The real question is who saw this coming, and why smart money appears to be moving early. Because if history is any guide, silver doesn't move like this without a reason. And by the time the public understands it, the biggest gains are usually already gone. If you want clear, simple explanations about the economic forces shaping your future, make sure you like this video and subscribe to The Silent Collapse right now, because we break down the signals most people only recognize after it's too late. And today's signal might be one of the most important market warnings of the year. Let's start with something most investors misunderstand. Silver is not just a precious metal. It sits in a strange position between gold and industry. Gold reacts mainly to fear and currency weakness, but silver reacts to fear, inflation expectations, industrial demand, and liquidity shifts all at the same time. That means when silver starts accelerating during geopolitical tension, markets may be pricing in more than just conflict headlines. They may be pricing in economic consequences that haven't fully appeared yet. As tensions connected to Iran escalated, energy markets reacted first. Oil volatility increased almost immediately, shipping insurance costs rose, and investors began quietly repositioning portfolios. Historically, when energy uncertainty rises, inflation expectations follow. And when inflation expectations rise, investors start searching for assets that cannot be printed or diluted. Silver becomes attractive because it is both a monetary metal and an industrial necessity used in electronics, solar panels, defense technology, and advanced manufacturing. Let's start with something most investors misunderstand. Silver is not just a precious metal. It sits in a strange position between gold and industry. Gold reacts mainly to fear and currency weakness, but silver reacts to fear, inflation expectations, industrial demand, and liquidity shifts all at the same time. That means when silver starts accelerating during geopolitical tension, markets may be pricing in more than just conflict headlines. They may be pricing in economic consequences that haven't fully appeared yet. As tensions connected to Iran escalated, energy markets reacted first. Oil volatility increased almost immediately, shipping insurance costs rose, and investors began quietly repositioning portfolios. Historically, when energy uncertainty rises, inflation expectations follow. And when inflation expectations rise, investors start searching for assets that cannot be printed or diluted. Silver becomes attractive because it is both a monetary metal and an industrial necessity used in electronics, solar panels, defense technology, and advanced manufacturing. But here's where things get interesting. Recent trading data shows unusually large institutional orders entering silver futures markets during periods of low retail activity. This pattern has appeared before major macroeconomic shifts in the past. It doesn't automatically mean manipulation, but it strongly suggests that large players are positioning ahead of expected volatility. Markets rarely move purely on news. They move on expectations of what comes next. Some analysts believe rising geopolitical risk increases the probability of supply disruptions. Iran sits near critical global shipping routes, and even small disruptions can ripple through global trade. When supply chains become uncertain, manufacturing costs increase. When manufacturing costs increase, inflation pressures grow. And when inflation fears grow, investors historically move toward hard assets, especially silver, which remains undervalued compared to gold on long-term ratios. Another layer few people discuss openly is currency confidence. During geopolitical crises, governments often increase spending. Defense budgets expand, emergency funding rises, and debt issuance accelerates. Markets begin asking a simple question: how will all this spending be financed? If investors suspect future currency weakening, precious metals often become a hedge against purchasing power loss. Silver, being cheaper than gold, attracts both institutional and retail demand simultaneously, creating sharper price movements. Now let's talk about forecasts. Several market models track what's known as the gold to silver ratio, a historical measure comparing how many ounces of silver equal 1 ounce of gold. When uncertainty rises but silver remains relatively cheap, analysts interpret it as a delayed reaction. Historically, silver tends to catch up suddenly rather than gradually. This is why silver rallies often feel explosive instead of steady. Some insiders within commodity trading circles have hinted, not publicly confirmed but widely discussed, that hedge funds are increasing exposure to metals as protection against what they see as a fragile global liquidity environment. Central banks worldwide have already been accumulating gold at record pace over recent years. While central banks rarely buy silver directly, their actions indirectly strengthen the case for precious metals overall, pushing investors further down the metals chain toward silver. Market manipulation is another topic that sparks intense debate. Silver has long been accused by traders of price suppression through large derivative positions. Whether fully proven or not, the structure of futures markets allows massive paper contracts to influence short-term pricing. During periods of geopolitical stress, however, physical demand can overwhelm paper positioning. When real buyers demand delivery instead of speculation, price movements can become sudden and aggressive. We've seen similar setups before. During past crises, silver initially lagged, then surged rapidly once investors realized inflation risks were not temporary. The pattern often repeats: early skepticism, quiet accumulation, sudden breakout, and then widespread media coverage only after prices have already moved significantly higher. Another reason silver responds strongly to Middle East tensions involves the energy transition. Renewable energy infrastructure relies heavily on silver due to its unmatched electrical conductivity. If geopolitical instability affects oil markets, governments accelerate investments in alternative energy security. That increases long-term industrial demand for silver, a factor markets begin pricing in long before construction projects even start. Meanwhile, retail investors are only beginning to notice. Google search trends for silver investing typically rise after price spikes, not before. This delay creates an advantage for institutional players who monitor capital flows instead of headlines. By the time everyday investors hear that silver is booming, professional money has often already built positions. There's also a psychological component. Markets run on narratives. War creates uncertainty. Uncertainty creates fear. Fear changes risk tolerance. Investors move away from speculative assets toward perceived safety. Even a small percentage shift in global capital allocation can create massive price movements in relatively smaller markets like silver. Liquidity conditions add another hidden layer. When central banks signal possible rate cuts or financial support during unstable periods, excess liquidity eventually looks for protection against inflation. Precious metals historically benefit from this environment. Silver, because of its smaller market size compared to gold, reacts faster and more dramatically to new capital inflows. Some analysts believe the current silver movement may not be about today's conflict alone, but about expectations of prolonged instability. Markets care less about single events and more about duration. If investors believe tensions could last months or years, they begin restructuring portfolios rather than making short-term trades. And here's something rarely discussed publicly. Volatility itself attracts capital. Hedge funds seek assets capable of large percentage moves. Silver's historical volatility makes it appealing during uncertain periods. Increased speculative activity then amplifies price momentum, creating a feedback loop where rising prices attract more buyers. At the same time, mining supply growth has remained relatively slow. New silver mines take years to develop, meaning supply cannot quickly respond as sudden demand increases. When demand spikes faster than supply, prices adjust upward to balance the market. This structural limitation often surprises investors who assume commodities respond instantly. Another possible factor involves currency diversification strategies among global investors. When geopolitical alliances shift, nations and institutions sometimes reduce reliance on specific currencies. Precious metals provide neutral assets outside political systems. Even rumors of diversification strategies can influence trader expectations. As the story develops, financial media may frame silver's rise as a simple reaction to headlines, but markets are rarely simple. Prices reflect thousands of decisions made by institutions analyzing risk scenarios most retail investors never see. The Iran conflict may simply be the catalyst, revealing deeper economic stress already building beneath the surface. The most important takeaway is not panic or prediction, but awareness. Markets send signals before economic changes become obvious. Silver's behavior suggests investors are preparing for inflation, uncertainty, currency volatility, and prolonged geopolitical risk rather than a short-lived event. And if history repeats, the biggest moves often occur when public attention finally arrives. That moment usually comes with dramatic headlines, sudden price spikes, and widespread fear of missing out. By then, early positioning has already happened quietly. This is why understanding the why behind price movements matters more than chasing the movement itself. When you understand the mechanics, energy risk, inflation expectations, institutional positioning, liquidity cycles, and psychology, market behavior becomes less mysterious and more predictable. As we move forward, watch three signals closely: energy price stability, central bank policy shifts, and physical metal demand trends. If all three continue aligning, silver could remain volatile and potentially trend higher, though markets always move in cycles and corrections are normal. The bigger story may not be about one war or one country, but about a global financial system adjusting to uncertainty after years of easy money and relative stability. Silver, historically, acts like an early warning indicator during these transitions. Before we wrap up, I want to hear your perspective. Do you think silver is reacting mainly to geopolitics, inflation fears, or something deeper happening inside global markets? Drop your thoughts in the comments because discussions like these help everyone understand the bigger picture. And if you found this breakdown valuable, share this video with someone who follows markets but hasn't connected these dots yet. You're watching The Silent Collapse, where we decode the signals behind the headlines, not to create fear, but to create understanding. Because in financial history, the biggest risks are rarely the events everyone sees, but the trends quietly forming underneath them.